to the Startup Funding Espresso. I'm Hall T. Martin, where we talk about how to raise funding and invest in startups and the time it takes to drink an espresso. If you have a question about startup funding or investing, please go to the website, startupfundingespresso.com, and type in your question into the chat bot in the lower right corner to receive an answer. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. The lifetime value to cost of customer acquisition ratio is called LTV CAC and is a useful ratio in determining the health of a startup. To calculate the lifetime value, take the monthly revenue and divide by the churn rate. To calculate the cost of customer acquisition, take the number of new customers for a month and divide by the cost of sales and marketing for that month. Compare the LTV to CAC to determine the ratio. The ratio must be at least 3-to-1 to prove the business viable. The higher the LTV CAC, the higher the gross margins and profit margins. This provides a greater reinvestment rate into the business. Investors place a high valuation on startups with higher LTV CAC ratios. SaaS businesses often have a 5-to-1 LTV CAC, which comes from the recurring revenue. SaaS businesses at the Series A level often have a 7-to-1 LTV CAC. The higher the multiple, the higher the growth rate for the company. Check the LTV CAC rate of a startup to determine its growth prospects. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start listening to today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.